Welcome to my channel. I'm going to show you step-by-step how to value a stock. Together, we will enter the company's financial information and capital structure into my Excel model. Then we determine whether the stock is a buy or a sell. At the end, we calculate and analyze the financial ratios. The company we're going to look at is Restoration Hardware. They sell upscale home furnishings. Let's get started with the model. They have a market cap of $6 billion. And let's see what they're trading at. $310.60. So one share of stock is $310. Not a cheap stock. Let's get their free cash flows. And the way you value a company is you estimate the future free cash flows, and then you discount that number back to today's value. And they have positive free cash flows in 3 of the 4 years. And now we also need the net income, which is the profit and loss for the business. And this is accounting profit and loss. So there's a lot of non-cash items on the income statement. And they have positive net income in all the years, although 2 years it's pretty low. And we're going to get the revenue, which are the sales for each year. And the sales go up every year, so that's good to see. Really low income in 2016 and 17. And let's see why they had negative free cash flow in 2017. The way you calculate free cash flow is you take the net income and then you add back the non-cash items on the income statement. And then you subtract the investment in property, plant, and equipment. So you can see in 2017 they had $5.4 million of net income. And when you add back the non-cash items, it comes up to $78 million of cash flow from operations. Then you have to subtract the investment in PP&E. And they invested more that year than the other years, $157 million. So it did bring it down to negative that year. But there's a lot going on the statement of cash flows, and we could spend hours looking at this, but that's just a pretty high-level explanation on this particular instance. Let's move forward with the model. And the net profit margins are improving. It went from 0% in 2017 and 18 to 6% in 19 to 8% in 20. And net profit margin is net income over revenue. It's how well you convert your revenue into profit. And profit is really the most important part, because as the investor, that's what you get, the profit. That's where your dividends come from. Let's look at the capital structure. Let's get the interest expense. We need to figure out how much interest the company pays on its debt. And they pay $84 million of interest. That's on the income statement. Let's go to the balance sheet to see how much debt they have. We'll go to the liabilities section. Current debt of $365 million. Long-term debt of $581 million. So they pay a hefty interest rate, 8.9%. It says interest payments are tax deductible. Let's get their effective tax rate. So the income before tax is $269 million. The income tax is $48 million. So the effective tax rate is 18%. To get the cost of debt, it's the interest rate on the debt times 1 minus the effective tax rate, which comes out to 7.3%. And now to get the cost of equity, we need the beta. That's how volatile the stock is relative to the market. The market as a whole has a beta of 1. This has a beta of 2.57, so the stock moves 2.5 times the market. It's a pretty volatile, risky stock. Let's go back to the balance sheet to get their current assets, because we need to calculate the current ratio later. And current assets are part of their current ratio equation. And that's $597 million. Let's see what that is. $48 million cash, $49 million net receivables. It's mostly inventory, $438 million of inventory. They also have $20 million of other current assets. We also need the current liabilities to calculate the current ratio. That's $982 million. And let's see what that is. Current debt of $365 million, accounts payable of $181 million. Accounts payable is how much money the company owes its creditors and suppliers in the next 12 months. Accrued liability is $65 million. These are expenses the company incurs but has not yet paid. When it does pay it, it will take it out of accrued liabilities. deferred revenue of $179 million. So this company received $179 million of revenue from sales, but it has not yet delivered the product yet. When it delivers the product, then it pulls it out of deferred revenue. Other current liabilities are $24 million. Stockholders Equity is the value of the company according to the balance sheet, and that's $18.5 million. And let's see what that is. That's 2,000 of common stock, 409 million negative of retained earnings. Retained earnings is how much money the company has left over after paying its dividend. So it's at a negative, which isn't good. That means historically they're operating at a loss, because retained earnings is all your prior net incomes minus your prior dividends. Accumulated other comprehensive income of negative $2.8 million. This is unrealized losses on some of its securities. Unrealized means it has not yet sold those securities to realize them. Let's look at the income statement. We need the operating income. That's $363 million. That's how much money the company earns from its operational business. And we need that number to calculate the interest coverage ratio later. So the capital structure is 98% debt. The cost of debt is 7.3%, 2% equity, the cost of equity is 22%, and the WACC is 7.5%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows, that's up here in blue. We also estimated a terminal value, which is all cash flows past year 4, that's $2.3 billion. We had to present value these numbers back to today's dollar amount using the weighted average cost of capital, that's here in green, and we get a value of the company at $2 billion. We divide it by 19 million shares and we get an intrinsic stock price of 106. It's trading at 311, so it's trading at a significant premium, so it's a sell according to the model. Let's see what Simply Wall Street says. They're much higher, they're at 278, so they think the stock is worth what it's pretty much trading at. Let's see where it's been trading at the past few years. So it looks like the price has really been driven up during coronavirus. It's at an all-time high. So investors don't see it the way I see it. They see the value of the company going up in the future, and it's really about what investors feel. It's not about what the company's actually doing. Let's look at the financial ratios to see if we get more information. Bad PE, a good price to sales, and a really bad price to book. PE is stock price over earnings per share. Earnings per share is net income over shares outstanding. Their PE of 27, I like to see below 15. This indicates investors are willing to pay $27 for $1 of earnings. Price of sales is stock price over sales per share. Sales per share is revenue over shares outstanding. They have a price of sales of 2.3. I like to see below 2.5. This indicates investors are willing to pay $2.30 for $1 of revenue. Price to book is stock price over book value per share. To calculate book value per share, it's equity over shares outstanding. They're at 321. I like to see below 3.5. This indicates investors are willing to pay $321 for $1 of book value. Bad current ratio, really good ROE, and a good interest coverage ratio. So current ratio is current assets over current liabilities. They cannot cover their current debt, so they need to take on more debt. ROE is net income over equity. It's so high because there's so much debt and they have so much little equity in their capital structure. Interest coverage ratio is EBIT over interest expense. They can easily cover their interest payments. And the best way to look at ratios is to compare them to similar companies. I've done videos on Big Five, Canadian Tire, Office Depot, Ulta, and Williams-Sonoma. And Restoration Hardware is here in the middle. If they have a number in red, they're worse than the average. If they're in green, they're better than the average. So they're worse than the average in almost every category. Although in ROE, they're much better than the average just because they have almost all debt, 98% debt, much worse than all the other companies. And they're average in terms of market cap. So it could be a risky play. You don't know if this company's going to file bankruptcy. They have really poor numbers, but it's really dependent on what investors feel the company's worth. And if they keep driving the price up, it's going to keep going higher. If you were to short the stock, that can also be really risky because if the price keeps going up, you're going to be losing a lot of money on your short. You just don't know when it will go down in price, if it does. Leave a comment, and thanks for watching.